Hello friends, this is Professor Amarjeet Kaur. I've been working with Gurugram University from the last couple of years and I have worked in food industry for about 5.5 years and more than 3 decades that I've been now working. So it's my privilege that I'm here with you to talk about capital structure theories. This is the part 3 in this regard which we are going to begin today. So, friends, in the past we have talked about a couple of discussions have been taken place. We have talked about capital structure theory, especially given by Durand, net income approach, and today we are going to talk about the other theory which is also given by Durand only. He himself challenged his own theory, net operating income approach primarily, and we will also look into the assumptions, the practical aspect of NOI as well. So friends, this discussion is pertaining to financing decision in the financial management. Every company, be it a small or a big, has to decide about the financing source. A small company may have a smaller requirement for funds, a big company may have a bigger requirement. Irrespective of the requirement, they may have different risk type, they may have different industry type, they may have different growth prospects, everything, keeping all the factors in mind. But companies need to take a call on how to fund the requirement of finances for sure, right? So primarily we divide all the sources of financing into two parts, equity and debt. So equity is ownership fund and the debt is debenture or the loan amount, right? So two sources are there, equity sources and debt sources. More the debt component means the more the leverage we have. So we have to talk about the leverage aspect as well because it affects the total structure and the value of the firm. So calculating the capital structure and preparing the plan depends upon the type of the business, and the evaluation of the structure must be maintained in such a way so that the ROI is always higher. So with this discussion in mind, we have so many theories which have been given by many researchers. The first theory is net income approach, then we have net operating income, traditional approach, Miller-Modi-Gilani approach, and we have 4 more, trade-off theory, packing theory, signaling theory and bankruptcy theory. Today we are going to discuss about net operating income approach in this session, the second one, and the remaining theories will be discussed in future sessions, right? So please stay with me to learn about net operating income approach. So what is the net operating income approach? I will explain you step by step, and all the practical aspects will also be discussed in the due course of time. So the essence of this approach is that any change in leverage will not lead to any change in the total value of the firm, the market price of share as well as the overall cost of capital. Hence, capital structure decisions are irrelevant for the firm. I hope you could get the essence. This theory says that the capital structure decisions are irrelevant. They do not affect the value of the firm, they do not affect the overall cost of the capital, and hence they are not so relevant for the firm when it comes to value of the firm. Means value of firm and the capital structure has no connection between them, these two aspects. And interestingly, this very theory is also given by the same person, Durand, who gave the first version, net income approach, and he called this approach as NOI, net operating income approach. Why? What kind of explanation does he give? So he says the advantage which is associated with using the debt funding, which is supposed to be cheaper source, right? it is going to is going to be very equally settled down, traded off by the increased cost of equity. So, which means there is no optimal structure at all, so optimum capital structure does not exist. Alternatively, capital structure are all are optimal. So, this is something interesting, because he says if a company wants to increase debt component, the effect of saving the cheaper source, because debt assumption is there that debt is a cheaper source. So, that effect of saving the cost because of the being the cheaper source is neutralized. It is been settled down, it is set off rather by the increased cost of equity. The moment that is increased, the equity shareholders will demand for more returns, more dividend or dividend at a higher price, and that difference of saving the interest in terms of lesser expensive source as a KD, we end up paying more to KE to equity shareholders. So, that difference is equal, very much equal, which is really not a practical assumption. Otherwise, it is true that if the debt component is increased, after a certain time period, the shareholders will start demanding for more returns, because the company becomes more riskier. So, this is the crux of the net operating income approach. Now, like any other approach, any other theory, this is also based on certain assumption. What are those assumptions? The first very assumption is the investors see the firm as a whole, not as a as isolated from one to the another aspect of financing. They see company as a whole, and thus they capitalize the total earning of the firm to find the value of the firm, not earning pertaining to shareholders or earnings out of the debt fund or out of equity fund. They take company as one single entity, and that is how they see the firm as a whole and to find out the value of the firm. And the second assumption under NOI is the cost of debt is constant and there is no tax. It means if we increase use of debt, the debt cost is equivalent and the taxes are not there. So, with these assumptions, there's one more assumption which has been there assumed. The overall cost of capital KO of the firm is constant and it depends upon the business risk, which also is assumed to be unchanged or constant. So, there are so many unreal, impractical assumptions, but this is what is the theory, because we want to understand the impact or nuances of capital structure decisions. We are not trying to understand this theory per se. We are trying to understand the implication of changing leverage, changing financing options, or adopting debt over equity or equity over debt, and we want to understand the nuances so that we make a very good structure, we decide a good structure for the company. Otherwise, not theory per se, because they are all the theories are based on certain assumptions, including the unrealistic ones. So, if I want to explain this particular theory NOI with the help of graph, here is a graphic presentation. So, if you look at the x axis, we have degree of leverage, means the amount of debt in the total financing. So, 0.1 means 10%, then 0.2 20%, 30%, 40%, 50% and 60%. On the left side, on the y axis, we have cost of capital 5% and then 10%. There are two costs are given. So, here we see if the cost of debt is constant at 5% and cost of equity, cost of overall capital is also constant at 10%. it seems the it has moved little bit, whereas the cost of equity is increasing, right. So, cost of equity is little bit increasing, causing the effect which is because of the using of debt, which is a cheaper source. It is setting off the effect because there is an increase in the equity cost. So, the cost which we save by using the debt funding is very much equally settled down by increasing by the increasing cost of equity for the same company, bringing the overall cost of capital at the same level, right. So, overall cost of capital remains unchanged because of this effect of increased cost of equity. So, this is the graphic presentation. If I talk about the application of net income approach, net operating income approach, let's now take up the step by step effect of net operating income in calculating the cost of equity. So, friends, let's have a look at the steps which we follow, the application of NOI in reality. The first step is to determine EBIT, either it should be given in the example or case, or you need to calculate it. Then we compute NI, net income, which means EBIT minus I, which is equal to NI. The third step is to compute market value of the firm V. Unlike NI approach, in the past sessions and I have discussed NI approach, where we were calculating value of S and value of D first. Here, if you look at the steps here carefully, we are calculating value of firm first, V first, and then we are deriving the market value of debt and market value of equity. Market value of debt is I divided by KD, and market value of equity is S, which is denoted as S, which can be calculated by V minus D. V is the value of the firm, which is already calculated at step number 3 here. At step number 4, we calculate the value of D. If we subtract D, the value of debt, out of V, which is value of firm, the difference is S, the value of equity. So, step number 5. Last step is to calculate the value of equity, the market capitalization rate of equity, which is NI divided by S. So, these are the steps which we follow. So, considering or remembering these steps, we will learn how to apply these steps to actually calculate KE for certain examples. Let us take up one example, but remember that we are using symbols. V is the value of firm, which is equal to E plus D. V can be calculated by other way, EBIT by KO, or it can be D plus E or B plus E or S plus D as well, right. Value of S or equity firm, equity is equal to market value of equity, which is NI divided by KE, and D or B is the market value of debt, which is I divided by KD. So, remember these formulas and the steps we followed just in the previous slide. Now, we shall be taking up some small caselets to help you understand or help you apply NOI approach in practical. So, here goes a small caselet. A company is expecting the net operating income of rupees 2 lakhs. The company has debentures of rupees 6 lakhs at 10% interest payable. The overall capitalization rate is given, the KO is given 25%. Calculate the value of the firm and the equity capitalization rate, which is KE under NOI approach. So, we have to calculate two things, value of the firm as well as KE, because KO is given, right. Either KO should be given or KE is given. In NI approach, KE was given. Here KO, overall cost of capital or overall cost for the company, or or weighted average cost of capital is given, which is 25%, and we have to calculate KE and V, right. So, this is the example or the case in front of you. So, how to calculate? This was the case. Part B of the case says, what will be the impact on the value of the firm and equity capitalization if the debenture amount is increased to 7,50,000. So, previously here we assumed 6 lakhs, right. From 6 lakhs to part B says 750. Now, with this data in mind, with these numbers in mind, let us go to the solution. Solution, we will follow the steps we just discussed. EBIT 2 lakhs, right. NI net income will be EBIT minus I would be 60,000 in the first case, part A, we are solving part A, where we have debentures of 6 lakhs at 10%. So, I comes out to be 60,000. So, if you subtract 60,000 out of 2 lakhs, it becomes 1,40,000, right. Now, the next step is to calculate the value of firm V. V is EBIT divided by KO or weighted average cost of capital. EBIT is 2 lakhs divided by 25%, which is given, KO is given, so 0.25. This gives you the value of the firm, it comes out to be 8 lakhs, right. Now, D is given 6 lakhs, otherwise I divided by KD is equal to D, but it is also given straightway as well. So, 6 lakhs, what would be S or E? S, shareholders value, market value of shares, or market value of E would be what? The value of firm minus value of debentures, which is 6 lakhs. Now, step 4 we calculate it. So, step 3 is the value of firm 8 lakhs minus value of debt 6 lakhs. So, we get the value of equity 2 lakhs. So, at step number 5, if you look at the row number 5, so here we are talking about V minus D, V 8 lakh minus 6 lakhs comes out to be 2 lakhs. Now, we have to calculate KE. So, we answered the first part, value of firm and value of firm is calculated, and now the last part here it says, second part it says KE. KE is NI divided by S. NI we calculated at step number 2, right, 1,40,000. So, divided by S. S we have calculated in the previous steps 2 lakhs. So, 1,40,000 divided by 2 lakhs gives you the answer 70%. It's a very high cost, but these are the assumptionary figures because I am helping you learn calculation here. Okay, so this is the calculation of KE. Now, part B we assume that debentures are changed from 6 lakhs to 750. What would be the cost of equity and the value of the firm? So, if we increase debentures from 6 to 7,50,000, my interest obligation goes up, right. 10% of 750 would be 75,000. So, taking the same EBIT remains same in the example, 2 lakhs less net income of 70, net income can be calculated by subtracting interest of 75,000 out of 2 lakhs. So, 2 lakhs EBIT minus interest 75,000, it comes out to be a net income of 1,25,000. So, value of firm in the step number 3 can be calculated by dividing your EBIT of 2 lakhs with the given overall capitalization rate of 25%, 0.25. So, if you divide 2 lakhs by 0.25, which is capitalization rate, so value of the firm is 8 lakh. It is same either you use 6 lakhs of debenture or if you use 7,50,000, 7,50,000, because NOI approach says the value remains same, right. So, value remains same and KO remains same, overall cost, because we have already assumed it is 25%. So, both are same, what is changing is KE is going up, because of the increased debt. That's what we have to prove, that KE goes up. So, the B or D can be calculated by dividing interest with the interest KD. Interest was annual interest was 75,000, KD was 10%, so 7,50,000, and otherwise it is directly given. S is V minus D, which is coming out to be 50,000 at step number 5, and the last step would be to calculate KE, which is NI. NI is net income. Net income was 1,25,000 divided by your S, value of firm 50,000. It comes out to be very high, 250%. So, it is quite a high cost of for the company, and it proves with this example it is clear the value does not change and overall cost of capital does. In fact, we are assuming that does not change because both the examples they both are same, and the effect of increased debentures in the total leverage is actually traded off, is settled down, is neutralized by the increased cost of equity. That is what it has been proven in this example, and that is what the approach says, and we are able to prove because we are using assumptions, right. So, we will take up few more example to understand how to calculate different aspects of it with pertaining to NI, NOI approach. So, let us take up one more example here. The example goes like this: company A and company B are in the same risk class and are identical in every respect except the company A uses debt while company B does not. So, two companies A and B, A is using debt, the first company is leveraged company and company B is not using debt. So, company is unlevered, B company is unlevered. The levered firm has rupees 10 lakh debentures carrying 10% rate of interest. Both the firm earn 20% operating profit on their total assets of 20 lakhs. 20 lakhs is the investment, 20% means they are earning 4 lakhs both. Assume perfect capital market, rational investors and so on. So, these are the assumption, and the tax rate of 40% we have been given. So, assume a tax rate of 40% and the capitalization rate of 15% for an all equity firm. This was the first. So, what is to be calculated? Number 1, compute the value of the firm using net operating approach for both the firms, right, A and B, and B, using the NOI approach, calculate the overall cost of capital. So, we have to calculate what? The first one is V, second is using NOI approach, overall cost of capital KO for both the firm X and Y or A or B, whatever you may call, and which of these two firms has an optimum capital structure according to NI approach and why. That is what we have to answer. Okay. So, this is a good case where we have been given two different companies, and one of them is levered, another is unlevered. A or X, A is levered and B is unlevered, means A is using debenture, B is not using any debt funding. So, step by step we will try to solve all the three situations. A is part A of the question or the case is to calculate V, value of the firm. So, let us calculate the value of B firm, which is unlevered firm first, and then we will calculate the value of levered firm. So, value of unlevered firm is equal to 4 lakh, which is the net income, into 1 minus tax rate of 40% divided by capitalization, overall capitalization rate of 15%. Right. So, 4 lakh multiplied by 1 minus 0.40, 40%, that is tax rate 40%. The whole is divided by capitalization rate of 15%. So, that is equity capitalization rate of 15%, that gives you value of firm B. 16 lakhs, and this is unlevered firm, and value of levered firm would be the value of unlevered firm plus the debentures minus the tax benefit. So, 10 lakhs are the debentures multiplied by 1 minus tax rate or multiplied by the tax, so tax benefit. So, it gives you so we will reduce it by the tax percentage is 40%. So, value of firm A, which is levered, would be value of unlevered firm 16 lakhs plus the debentures multiplied by the tax rate 40%. So, it comes out to be 4 lakhs, right. So, 16 plus 4 means 20 lakhs. So, value of firm A is 20 lakhs and value of firm B is 16 lakhs, which means value of levered firm is more than the unlevered firm only to the extent of tax rate. So, the previous examples we considered were given by Durand without tax benefit. This example I am taking while considering the tax benefit. He modified his version saying that the value of levered firm, means the company which is using debt funding, would be higher than the unlevered firm, but to the extent of tax benefit, that is it. And that is why we calculated the value of unlevered firm B first, then added the value of the debenture by reducing it to the tax rate, and it comes out to be 20 lakhs. This was part A. Part B is to calculate K O for the companies, both the companies. So, EBIT is 4 lakhs for both. Interest would be there 1 lakh for the first company, not for the other company, because 10 lakhs debenture at 10%. So, taxable income for 3 lakhs for A and 4 lakhs for B, less taxes at the rate of 40%. So, 1 lakh 20,000 which is 40% of 3 lakhs and 1 lakh 60,000 for B, which is 40% of 4 lakhs taxable income, right. So, net income comes out to be 1 lakh 80,000 and 2 lakh 40,000 for A and B respectively. Then V, value of firm, would be 20 lakhs and 16 lakhs, NI divided by, we can calculate that. Then B is 10 lakhs only for A, not for B, and S is value of firm equity shares for firm A is 10 lakhs and for B it is 16 lakhs. We calculated in the previous step, last slide. And if you divide NI by S, that gives you the cost of equity, 18% and 15%, and KD can be calculated by 10% the tax without tax cost of debt multiplied by 1 minus 40%. So, 6% is the cost of debt in net. And the last step is calculation of the overall cost of capital, EBIT divided by V. So, which is coming out to be 20% for firm A and 25% for firm B, right. So, last aspect was the optimum capital structure. If I have to comment, neither of the two firms have any optimum capital structure. According to this approach, under this assumption, the optimum capital structure requires 100% debting. So, this was the discussion of NOI approach considering tax benefit and tax component or tax application to it. So, friends, I hope you were able to understand net operating income approach with and without taxes. We discussed in detail, and now this is the time to wind up. Thank you very much.